Hello everyone, our lesson for today is about the terms used in bookkeeping. So if you are and will be a bookkeeper someday, you must make yourself familiar with the following terms. The first one is accounts. Accounts is a formal record that represents in words, money, or other unit of measurement, certain resources, claims to such resources, transactions, or other events that result in changes to those resources and claims. All accounting in the chart of accounts or general ledger fall into three main categories, and these are the asset, liability, and equity. Asset accounts have a debit balance and represent the resources a company has at each disposal. Liability accounts have a credit balance and represent the money that a company owes to other entities. And equity accounts also have a credit balance and they represent the owner's stake in the company. So, what is accounting? Accounting is the recording and reporting of financial transactions, including the origination of the transaction, its recognition, processing, and summarization in the financial statements. So these are the example of financial statements: the balance sheet, income statement, cash flow statements, and profit and loss statements. Now you have to remember this. If math has an equation, accounting also has an accounting equation. So accounting equation is asset equals liability plus equity, or assets minus liabilities is equals to equity. And you have also the accounting period or year is a period of 12 consecutive months chosen by an entity as its accounting period, which may or may not be a calendar year. A calendar year meaning from January to December within that year. But when you say accounting period, it may either be from June 2021 to June 2022. It depends on, but as long as it has a 12 consecutive months. Next is accounts payable. It is the amount owed to a creditor for delivered goods or completed services. So if you have accounts payable, you also have accounts receivable. So these are amounts collectible from its customers. It is the claim against a debtor for an uncollected amount, generally from a completed transaction of sales or services rendered. The next one is adjusting journal entries, and these are accounting entries to account for a period changes, omissions, or other financial data required to be reported in the books or in the financial books. So here in our example, if you want to record amortization expense at the end of the accounting period, so you must make an adjusting journal entry, which is amortization debit 3,000, and then credit accumulated amortization, which is also 3,000. And then also if you want to reclassify the January rent, which is paid in December, you must also make an adjusting journal entry, which is prepaid expense 1,500 and credit rent expense, which is also 1,500. So you must always remember that your debit and credit must be balanced. Next one is adjusted trial balance. So here it reflects total after the adjusting entries are posted to the general ledger. So this is an example of an adjusted trial balance. Next one is assets. So asset represents future benefit to the company with a reliable measurement. So for example, you have your computers. So it depends on your business. Next is accounting manual. It is a document prepared to provide bookkeepers with direction and guidance in connection with those bookkeeping requirements of entities. So the next is balance. It is the sum of debit or debit entries minus the sum of credit entries in an account. If the balance is positive, the difference is called a debit balance. If it is a negative, it is called a credit balance. So here in our example, the balance is the cash or the balance of cash is 13,000. So and it is in the debit side. So it is called a debit balance. So if this 13,000 is in the credit side, so for example, the credit balance is 13,000. So this is also called a credit balance, and you must always put a double rule to remind you or to double rule is important to make sure that it is the final amount or the final answer of a certain account. The next one is the balance sheet. It is a report or it reports the financial position of a company at a point in time or end of the quarter or year. So it depends on the company, if quarter or per year. Next one is business. So business is the social science of managing people to organize and maintain collective productivity toward accomplishing particular productive goals, which is usually to generate profit. So if it is important, of course, that you have a business so that you will have transactions to record or to bookkeep or to record in your accounting books. Next is the capital, and it is also called as equity. And cash usually refers to the money in the form of liquid currency such as banknotes or coins. Then cash payment journal is a book used to record all payments made in cash such as for accounts payable, merchandise purchases, and operating expenses, also termed cash disbursement journal. The cash payment journal is used to record the cash disbursements made by check, including payments on account, payments for cash merchandise purchases, payments for various expenses, and other loan payments. A typical cash payment journal is shown in the example. The, uh, the journal has a date column, a check number column, a payee column, and at least two credit columns, one for cash and one for purchase discounts. And the other credit column is for other accounts. If necessary, other specific account columns can be added if they are used routinely. The debit columns will include at least an accounts payable column, a purchases column, and other accounts column. Again, other specific account columns can be added if needed. The main source of entries for this journal are check stubs and payment requests. Cash Receipts Journal is a book used to record all collections made in cash, such as for accounts receivable, merchandise sold, and interest income. So there are three types of cash receipt journal, and these are the receipts of cash from cash sales, and receipts of cash from credit customer, and lastly from other sources. Receipts of cash from cash sales are all cash received from cash sales of goods and services to customers. Is recorded in cash receipts journal, mentioning the name of the counterparty in the narration. Then, receipts of cash from credit customers, all cash subsequently collected after making credit sales to the customer or customer basis, the credit period advance. And lastly, the receipt of cash from other sources. It means all other sources of cash, such as bank interest, maturity of investment, sale of non-inventory assets, and sale of fixed assets. Next one is the chart of accounts, and it is a systematic listing of all accounts used by an entity. It helps in the quick identification of a business expenses and revenues. The account number corresponds to the respective ledger entry, and it can be 3 to 7 digits depending upon the company's size, divisions, and departments. So a small business will usually, of course, have three numbers only. The last one is the closing entries, and it is prepared after the financial statements have been completed. Closing entries, also called closing journal entries, are entries made at the end of an accounting period to zero out all temporary accounts and transfer their balances to permanent accounts. In other words, the temporary accounts are closed or reset at the end of the year. This is commonly referred to as closing the books. For the for an example, here's the closing entry example. So here the date is December 31, of course. Then account name is revenues debit, which is 36,300, and then credit income summary, which is 36,300 also. So you have to put a note, which is to close incomes accounts to income summary. So all revenue or income accounts are debited and credited to the income summary account. This resets the income accounts to zero and prepares them for the next year. Remember that all revenue, sales, income, and gain accounts are closed in this entry on our example. So that ends our